All right, welcome back, everyone. Today, I'm going to tell you about something that I bet your CPA has not told you. And this is a critical change to keep an eye on for 2022. And this is the perfect time to start looking at this as we're filing tax returns for the April 18th deadline. And if you're extending anything for the September and October deadlines. So make sure that you're considering this and for any deals going forward. So what I'm going to talk about today is the interest expense limitation, which all started with the 2018 Tax Cuts and Jobs Act. And it sounds like, okay, that's old news. That was 4 years ago. How come I don't know about this? Maybe it's not relevant. Well, it's relevant because a critical change kicked in starting in 2022 that was part of this that makes a huge difference. And so we're seeing a much larger effect, at least on my clients for sure. This is referred to as the 163J limitation, which, yep, it's another code section. You don't need to remember that. Just know that it deals with limiting interest expense. Essentially what this was it is a new calculation that ends up disallowing certain business interest if you're over the limitations. A lot of people thought, okay, this isn't going to affect me because when it first came out, it was pretty clear that most of the time, if you're under 25 million in gross receipts, it's not going to affect you. You are exempt. And so that was what people thought at first. However, if you actually dig further into how this works, it also applies to what the IRS calls tax shelters. And you might think, well, I have a legitimate business. I have a legitimate rental property. I'm not doing this as a tax shelter. I'm doing this to actually make returns, and if I pay tax, that's okay. Well, the IRS doesn't think of tax shelters the same way. They have their own definition of a tax shelter. And so the IRS says one item that makes you a tax shelter is if you are what they call a tax syndication. And a tax syndication is one where you have at least 35% of losses going to limited partners. And this could apply to limited partners in like a general partnership or a limited partnership type entity, or more commonly today, it could be members of an LLC that are not actively involved in the day-to-day management of the business or the decisions. And this is incredibly common in real estate, especially if you're raising money for a deal, whether it could be close friends or it could be an actual tax syndication where you're syndicating with a lot of different investors. You probably have a significant amount of the equity that are considered limited partners according to the IRS. And if you're taking advantage of tax deductions like depreciation and other things, then you're maybe generating a loss. And if that's the case, then you may be subject to these interest expense limitations. So to show you why this is such a big deal starting now, I'm going to first go into how you actually calculate the limitation. And it all starts with your adjusted taxable income. So let's go to the board and see what this looks like. So the calculation of your adjusted taxable income starts with knowing your taxable income. So this is what you would have expected to pay tax on, or the deduction that you, if it was a loss, what you'd be able to use to offset other income. But this was before the Tax Cuts and Jobs Act and before this new interest limitation. So afterwards, if you were subject to this limitation, you would have to then add back depreciation to that number, add back any amortization, add back the interest expense, and that would get you your adjusted taxable income. And then this number, your ATI, or adjusted taxable income, is what you would use to then calculate how much of your interest expense was limited. So originally, starting in 2018, it was 30% of your adjusted taxable income is how much you could deduct. So you would find your adjusted taxable income, multiply it by 30%, and that is your interest deduction. If your interest was more than that, then you would disallow it and you'd have to carry it over to potentially use in future years. Now, when we had the CARES Act during 2020, they did temporarily adjust it from a 30% to a 50% limitation for tax years 2019 and 2020 for most entity types, but it has since gone back down to 30% for 2021 and forward until this provision expires. Okay, so let's go to the board with a quick example of exactly how this could work. So let's say in this example that you have been able to generate a $10,000 taxable loss. So this is after taking depreciation deduction. So we're going to add back the depreciation, which here I'm using $40,000, and I'm just getting this based on a depreciable basis of 1.1 million. So maybe you bought like something for 1.5 million, depreciated over 27.5 years. For the building portion, gets you that $40,000 depreciation. So we add that back, and then we add back amortization. So that could be, for instance, loan fees typically have to be amortized. So maybe you're adding that back, and then you were adding back our interest expense, which is also $40,000. And this gets us to our $71,000 adjusted taxable income, or ATI. And then for 2019, and then for 2021, we would take that times 30%, and we'd get a limitation of $21,300, which is your deductible portion of interest expense. So instead of deducting $40,000, you can only deduct $21,300. So basically now you take your taxable income of $10,000, which was a loss, you add back which was disallowed. So if we can deduct $21,300 and our actual interest expense was $40,000, that means $18,700 is not deductible in this year. So we'd add it back, and now instead of having a $10,000 tax loss, you'd actually have an $8,700 taxable income. So you can see this made quite a difference, and this is before the change that I'm about to talk about for 2022 and going forward. So this is actually going to be much more dramatic than it was in the past. Again, for the most part, this only applies if you have limited partners and you're allocating losses. So one weird quirk in the law is that if you have positive income and you still have limited partners, you actually probably are not subject to this limitation because it's income. It really has to deal with losses being allocated to these limited partners. Now, of course, there's always exceptions, okay? And then exceptions to the exceptions, of course. Generally, right, interest expense is deductible. However, the exception is this 163J provision. And then one of the exceptions to that exception is if you're a real property trader business. So most rental real estate would be a real property trader business. Then you could actually make an election, and it was called the electing real property trader business election. And what this was is it said, okay, I am in a real property trader business, and so I'm going to elect out of having to run this calculation and limit my interest expense. But as a trade-off, I'm going to then change the depreciable lives of my real property to a 80S method, which in IRS terms really just means that it was a longer method and not eligible for bonus depreciation. So for residential real estate, this meant you elected to go from depreciating the building over 27.5 years to 30 years. And for commercial, it was 39 to 40 years. So really not that big of a deal on the surface. And for residential, this wasn't too much of a big deal. It really didn't affect cost segregation studies or other things like that. The real question became, if you're commercial, are you going to have tenant improvements? So this means if you have a commercial building, a lot of times the landlord will end up paying for certain improvements to get a tenant to move in there, and they'll cover those costs. And under the current law, most of those improvements are depreciated over 15 years, not 39. And because they have a 15-year life, according to the IRS, they're also eligible for bonus depreciation, which essentially means that you just write it off. Instead of taking the deductions over 15 years, in 2022, you'd be able to write off 100% of it. In 2023, it phases down a little, so you'd write off 80% of it and depreciate the remaining 20%. However, if you make this election to avoid the interest expense rules, one of the pitfalls for commercial real estate is those tenant improvements now become 40-year property instead of 15-year property and no longer are eligible for bonus. So your trade-off is that you're able to deduct the interest expense, but you're not able to deduct all of your tenant improvements in that same year. Now I'm going to talk about the change for 2022, but stick around. I'm going to give you a couple ideas other than making the electing real property trader business election and how you can get around it otherwise so that you don't have some of the trade-offs like changing your depreciable lives. So the big change in 2022, you no longer add back depreciation and amortization to calculate your adjusted taxable income. So obviously, if you're adding back less and then multiplying that number by 30%, your limitation is going to be a lot smaller, so you can deduct a lot less. Whereas in the prior years, maybe you weren't even limited. Maybe your interest expense was below 30% of your adjusted taxable income, whereas now it's going to be a lot harder to be below that. Compound that with the interest rates rising over the last year, so your interest expense alone may be higher, plus the limitation is lower. So you have both of those things happening. And so this year, we're seeing a lot more folks have to make a decision on what they're going to do about this. Okay, so now let's go back to the board and let's take a look at how this looks for 2022. And we'll use the same numbers as I did in the previous example. So we start with our $10,000 tax loss. Here, we're only adding back our interest expense, which was $40,000, nothing else. And then we're getting a $30,000 adjusted taxable income. So if you multiply that by 30%, and then you get a $9,000 limitation. So our interest expense was $40,000, but we can only deduct $9,000 if we're limited. So what does that mean? If we take our taxable income and we add back what was disallowed, so the 40 minus our 9 is $31,000 of disallowed interest expense deductions. So now you're being taxed on $21,000 of income instead of $10,000 loss that could potentially offset other items. So now you can see how this has such a big effect starting in 2022, because we went from, if you were limited, having $8,700 of taxable income to having more than double that at $21,000. So like I said, for residential, this may not be a big deal because we could elect the real property trader business election, avoid this calculation, deduct our loss, expand our depreciation over a slightly longer period. I didn't actually do the math, but maybe instead of a $10,000 loss, once you adjust depreciation, maybe you have a $9,000 or $9,500 loss. So not a huge deal, worth making the election. However, like I said, if you have commercial property, you have to think a lot harder about this. One way to get around this is if you had income in the immediately preceding tax year, the IRS actually allows you to elect to use that prior allocation. So remember when I said this usually only applies if you have a taxable loss, not income. So if you had income in the prior year, you elect to test that prior year income instead of the current year when you may have a loss, and then you can avoid being subject to this limitation, avoid the calculation for at least one more year. Now, if you have a loss in the current year, you may run into a problem in the following year. Maybe you're not subject to limitation that future year, or you come up with another way to try and get around it. Another way, other than testing the prior year, would be if you do have a lot of tenant improvements and you can push those into the next year. So if you're getting to the end of the year and you can push those expenses, so normally you want to accelerate them, take them now, but maybe you want to push them. That way, in the current year, you have a small amount of income, so you're not subject to limitation. You don't have to make the election. And then you spend the money in the next year in January or February, and you write it off, take bonus, and then you use that first way of getting around it that I just mentioned, which was electing to look at the prior year, which you had income in. So those are a couple ways to potentially get around it. Either way, I highly doubt that your CPA is mentioning this to you, but it has a huge effect for anyone that has any limited partners in their real estate or their business. So I definitely encourage you to look into this and consider it. And I hope this was useful, and I'll see y'all next time.